In today's lecture, we'll be starting with the introduction of accounting and we'll be explaining and discussing the topics on accounting. So, first of all, what do you understand by accounting? A systematic recording of information which involves analyzing, recording, summarizing, and reporting is basically known as accounting. See, in simple words, if I explain you anything or any activity in business that we can record in the terms of money is known as our transactions, and the process of doing or recording those transactions and analyzing my profits and losses from those transactions is known as accounting. Now, the second thing is reporting. Reporting, what is reporting? It is a business information for those who make decisions in the form of the financial statements. That is, we'll prepare some of the financial statements like profit and loss account, balance sheet, so that the investors of our business can take the decision and can decide that they have to invest their money for the future or not. So the next thing is, a person running his business, why does he needs to maintain accounting? See, first of all, every individual in the business needs to know what actually he owns. That what are the total assets and cash that actually belongs to himself. And the second thing that a person takes or thinks about is the responsibility, that is what he owes, the liabilities he carries in the business. And the most important thing that every businessman thinks about is the business is in the profit or loss. So we make the financial statements to calculate we have to continue the business or not. We are providing profits, we are generating profits or losses. So now the next thing is, we have to analyze the accounting system. In accounting system, now you will be able to analyze the general accounts, that is in which we are providing our statements, our details, and the activities or transactions that are happening in day-to-day business. Now those are sales, purchase, stock entries. I can use inventory in spite of stock as well, the customer record, supplier record, and our fixed assets. Fixed assets like land, building, machineries, etc. Now moving forward, we'll be discussing about the modes of accounting. Modes of accounting means how we maintain accounts, in which form we can make the accounting. So first comes is the cash memo. Cash memo, you are very well aware about the cash bill. So in which our cash details are mentioned is called the cash memo. Now the second is invoice. Invoice is a bill that we receive or we provide to our customer or we receive when we purchase some goods. Vouchers, I'll be discussing later on. Receipts, debit note and credit note. These are the modes in which we can record our transactions, our activities. Now, coming forward, first thing is the voucher. What is voucher? It is a document in support of a business activity containing the details of such transaction. Like, if I am making any of the transaction, in support of a document, a voucher is used to prove that transaction, to verify that actually this transaction has happened. So this is here, it is the receipt voucher in which I am taking Citibank as my ledger and we are providing the name of the supplier is A.R. Rahman and providing the check number in narration and telling the amount. So this is my voucher in which I am giving the details of such transaction. Now the next is receipt. When a trader receives cash from a customer against goods sold by him, he issues a receipt containing the name of such customer. For example, whenever you go to some of the shop or let's say to the petrol pump, you ask the boy, the petrol filling boy, for the receipt. Why you are asking about the receipt? Because you are paying him for the petrol services and you need the receipt that you had actually deposited the cash with that boy. So this is called the receipt. Now the next comes here is invoice or bill. See, what is invoice? When a trader sells goods to a buyer, he prepares a sale invoice containing the details like name, address of buyer, goods details like amount, terms of payments, and so on. Similarly, when the trader purchases goods on credit, he receives a bill from the supplier of such goods. So, in this invoice, there is invoice ID, issue date, due date, subject, and so on. In invoice, you will get each and every detail related to the transaction. Now comes to the journal. What is a journal? See, journal is a book in which you record the event or transaction of your business in a chronological order. What do you understand by the chronological order? It is the order in which you are recording the transactions as and when they are happening. See, it is very important to analyze that it is in the terms of money or not. Each and every transaction that can be calculated or evaluated in the terms of money has to be recorded in a chronological order, that is as and when they are occurred we have to record in the journal entry. Now the next here comes is your ledger. What is ledger? A ledger is a book which contains all the details related to your nominal account, personal account, and real account. See, these are the subsidiary books that we prepare after posting the journal entries. As we are accumulating a similar kind of transaction under the similar head, a single head, like I'll be preparing a cash ledger and I'll be recording all the transactions related to cash under a single cash ledger. Likewise, we'll be preparing sales ledger, salary ledger, revenue ledger, sundry creditor, debtor. For each and every person, each and every player, we'll be recording different ledger through journal entries. Now the next is financial events or transaction. See, any activity in your business that can be expressed or defined in terms of money is known as your financial event, or we can say it as financial transaction. For example, our company sold goods for rupees 20,000. So, is the transaction can be recorded in the books of accounts? Yes, we can record this transaction as this can be expressed in terms of money. So, this is my financial event. Like, I am taking a second example. A labor of our factory got hurt and he has a severe pain in his leg. So, is this transaction can be transferred or expressed in terms of money? No. This is our business activity that happened in our factory, but this cannot be converted in terms of money. So, this will not be called as the financial event or financial transaction. Now, the second thing we have to discuss here is the double entry system or bookkeeping. Whenever you talk to someone and you talk about the accounts, they'll be using the words again and again like double entry system, bookkeeping. So why they are using this double entry word? See, whenever any business transaction happens, it has two effects. One is on the debit side and another is on the credit side. Like if I talk about our company, in the company we sold some goods for cash of rupees 10,000. So what is happening here? Cash is going and goods are coming. So one thing is one ledger is increasing and another is decreasing. So there is a double effect. Now if I talk about company purchased goods worth rupees 5,000. So again my cash is increasing and my goods are decreasing. So each and every entry in our business, like each and every financial event in our business, had two-sided effect. One side, one gets increased and the another gets decreased. Now, the next concept comes is assets. What are assets? Anything which enable a business enterprise to get cash benefit in future. See, if you have anything that you can sell in the future and you get a real cash or the benefit, so that will be calculated as your asset. Like if you have some stock in your factory, then this will be your asset because this will provide you money. Now the second I can take is your factory. Whenever you sell the factory, this will give you the cash. Now your machineries, and like that there are so many assets that you carry in your business or organization. Now what are liabilities? Liabilities may be defined in a single term as responsibilities. See, every legal responsibility of a company that arises financial debt or obligations during the business operations are known as liabilities. See, they may be loans, accounts payable. Accounts payable means we have purchased something on credit and we have to pay to our suppliers. So here this will be calculated as liability. Now the next thing I'm taking you to over the capital. What is capital? See, whenever a person or an individual starts any business, he invests some cash or amount in the business to start or to run that business. So for the first ever amount invested in the company is known as the capital. So here it refers to the amount invested by the proprietor in a business enterprise. Now the next is debtor and creditor. See, who is debtor and who is creditor? In every time when you purchase or sale under credit, in a purchase transaction or in a sales transaction, a debtor and creditor both gets arised in the books of our company, and for in the books of another party, one party will be the debtor and another party will be the creditor. How? If I am purchasing the goods on credit, so I'm not paying the cash right now, but for future my liability gets stand, my liability get increased, so my creditors will be increased. I'll be increasing the creditors in my book. But vice versa, if I think about the person who is giving the goods to me on credit, so what he will be recording in his books? He'll be recording me as a debtor. Why? Because he has provided me the goods on credit and he has to take cash in future from me. So this will become the asset of that person and he will be recording me as the debtors and I'll be recording that person as a creditor. Why? Because liability increased in my books and assets increased in that person book. So whenever I purchase on credit, my creditors will be increased, and if I give a credit sale, I am allowing someone to purchase goods from me on credit, then my debtors will increase. Why? Because my cash will get increased in near future. I can take the amount from that person in near future, so this will become my asset. Now this is about the debtors and creditors. Now we'll be understanding about the types of accounts. See, in accounting, we have three types of accounts, that is real account, nominal account, and my personal account. Real account are those accounts that directly relates to our properties, assets, or of a business concern. Now, real accounts includes tangible and non-tangible accounts. For example, tangible means those assets which we can touch, like land, building, furniture, cash, and intangible assets like our goodwill of a company. We cannot touch the goodwill of the company, but we can calculate the amount on the basis of goodwill. We can pay someone. So these are the real accounts. Now next comes is a personal account. Personal account are those accounts related to a person, like supplier, as we discussed, customers, and lenders. Lenders are the persons who provide us the cash as a loan. As loan, like I can take an example of lender as bank. We take loan from bank, so bank is a lender. Now, nominal account. Nominal account is an account which relates to income and expense of a business concern. Like we had bifurcated our assets and properties accounts, we have bifurcated our persons account like supplier, customer, lenders. Now the rest of the accounts of incomes and expenses will be treated as the nominal account. For example, electricity expense, discount received, commission received, purchase, sales, these are all nominal account. You have to revise all these accounts, and we'll be continuing to learn the golden rules of accounts on the basis of these three types of accounts, real, personal, and nominal, in the next lecture.